On today's episode of Monday Matches, we're going to take a look at two growth companies that are super popular right now, and many believe they are on sale. I am going to do a point system. I'm going to take a look at different metrics, and at the end of this episode, I'm going to see which of these two stocks I like the most. The two stocks going against each other are Teladoc and Zoom, and if this is your first time here, make sure to hit the subscribe button. Don't forget to hit the thumbs up, and follow me on Twitch where I live stream taking a look at stocks you want me to look at. So let's get started. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services The Fool offers. Through the Motley Fool Stock Advisor service, you get access to a ton of expert stock picks. Every month you'll get 2 picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done some crazy returns. If growing your money is something you'd like to do more of this year, you can visit thefool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now back to today's episode. Alright, like I mentioned, today we're doing Teladoc versus Zoom, and this is going to be the point system. We're going to take a look at future growth, at historical revenue growth, at profit margins, at cash flow margins, at the overall balance sheet, price to sales valuation, and then finally the last one is going to be more of my thoughts of which one I'm more bullish on and why. So who do you think will win? Let me know in the comments below. Do you think it's going to go to Teladoc, or do you think it's going to go to Zoom? Alright, so the first point is going to go to future growth. Alright, so Teladoc is expected to grow its revenue 25.8% on average for the next 3 to 5 years, while Zoom analysts expect this company to grow 21.7%. So the obvious winner here is going to be Teladoc. Alright, so the second one, we're going to take a look at historical revenue growth. So Teladoc in 2020 grew its revenue 97.7%. In 2019 it was 32.4%, and in 2018 it was 79.4%. If we average it out, that's about a 69% growth annually for the past 3 years. This is a super growth stock for sure. Now let's take a look at Zoom. So Zoom's most recent revenue grew 326% compared to same time last year. In 2019, it grew 88%, and in 2018, it grew 118%. This gives an average revenue growth of about 177% annually for the past 3 years. So for historical revenue growth, Zoom has to take the lead here. It is insane. And it actually gives me thinking that maybe Zoom's future growth is being a bit conservative by analysts right now. Next, we're going to take a look at margin growth. And here in margin growth, what I'm doing is I'm going to take a look at trailing 12 months for both gross margins and profit margins and see how things are improving. So the first thing we can see, gross margins for Teladoc seem to be pretty stable around the mid 60%. That's actually a pretty high volume. Next, if we take a look at profit margins were ticking up. This company is not profitable at the moment, but we can see as the quarters have progressed, their profit margins are increasing over time. Most recently, their GAAP profit margins did take a big hit. I believe this probably has to do with their final merger of Livongo. Now, if we take a look at the margins for Zoom, it's definitely a whole different story. Gross margins for Zoom right now in trailing 12 months seem to be above 70%. The second thing we are seeing are profit margins have been improving since this company started, and they are now super profitable with profit margins of around 21.7%. So we can see both these growth stocks are seeing their margins improving over time, but I do see that Zoom's margins are a lot stronger. They are profitable already, and they have stronger gross margins. So we're going to have to give this point to Zoom. Next, I want to take a look at cash flow margins and how it's been improving over time. So first, let's start off with operating cash flow margins for Teladoc. We can see historically it has been improving, and it was profitable last quarter. If we're taking a look at trailing 12 months, it had an operating cash flow margins of about 9.17%. Again, this most recent quarter, it took a huge hit. And I want to say maybe it has to do with that Livongo acquisition. Maybe some of you guys, if you guys are super heavy on Teladoc, let me know why has this company seen a decrease in margins right now. But overall, we can see an overall improvement, which is nice. Now, if we take a look at operating cash flow margins for Zoom again is also killing it, continue to go up, and operating cash flow margins trailing 12 months are as high as 56%. This is a money-making machine right now. This is just printing out cash. So for cash flow margins, we're seeing the same thing as we saw in margins growth. Both these companies have been seeing an improvement in cash flow margins, and that's good. That's what you definitely want to see, companies getting better over time. Again, it just seems like Zoom has better margins. They are pretty much printing out money. So again, I'm gonna have to give it to Zoom here. So the next thing we're gonna take a look at is the balance sheet. And here I'm pretty much just taking a look at cash to debt ratio. So right now, balance sheet for Teladoc does not seem that bad. They have about $786 million in short-term investments, and they have about $1.4 billion in total debt. Again, for a company that is at least positive in cash flow from operations, this form of balance sheet doesn't scare me, right? Because they have positive money coming in from their everyday business to pretty much pay off their debt. But if we take a look at Zoom, Zoom has no debt at hand, and they have about $4.2 billion in cash and short-term investments. So this is actually looking like a really, really strong balance sheet. For this reason, I am going to have to give another point to Zoom. So again, the balance sheet is very similar to what we've been seeing. It's definitely okay for Teladoc. I'm not saying Teladoc is a bad investment at all, but it seems like the balance sheet for Zoom is so much more stronger. Next, we're going to take a look at price to sales valuation to see which one. There's so many metrics we can look at right now, but I'm just going to look at this one instead. And I can obviously see with which one has lesser growth right now, that I do believe it might be cheaper, right? Normally, you pay more for a company if it has a lot more to offer. And it seems like Zoom has a lot more to offer at the moment. So I do expect that one to be a bit more expensive. So we start off with Teladoc. For the next 2 years, the forward price to sales ratio is about 11.07. If we take a look at Zoom for the next 2 years, its forward price to sales ratio is closer to 21.49. I mean, it's pretty crazy. So obviously the point here is gonna go to Teladoc, right? But we have to give an understanding of why this company is a little bit cheaper than Zoom. It's actually almost half the price of Zoom when we take a look at price to sales valuation. But remember, Zoom has a lot strong revenue growth. It has a lot stronger margins. It has a lot stronger cash flow margins as well, where cash flow margins for TELEDOC were about 9%. For Zoom, they were about 5 times bigger. So I could see why the price to sales valuation is a lot more heavier on Zoom, and why it's cheaper on Teladoc. But regardless, we are going to give the point to TELEDOC right now. The final point is going to be which company I am more bullish on, which one I believe has a stronger moat, which one I believe is a market that I would more likely like to invest. So this is probably going to be more just my overall thoughts. And here, I'm pretty sure everybody can decide and give their own points wherever they want. So for those that are not familiar with either Teladoc or Zoom, let's just do a quick overview of what each company does. So Teladoc is pretty much just telemedicine. It allows you to get the care you need at the time you need it. So you can call your doctor, your therapist, medical expert anywhere via phone or video. So it eliminates the reason for you to go out and drive and go to your doctor visit. So obviously COVID situation has helped this out a lot, because not many people want to go to the doctors and risk getting sick by other patients. At the same time, I do believe after COVID is done and after everybody is vaccinated, people are just lazy. For example, me, I would rather do a Teladoc visit or some form of telemedicine visit instead of going to the doctor. So I do believe Teladoc, or the telemedicine market, is super strong, not only right now during the COVID situation, but after COVID is done. So for those that are not familiar with Zoom, they offer a video conference solutions. That's how they started off. But they do more than that. They do meetings and chats. They do video webinars. They do conference rooms. They also do a phone system. Again, due to COVID situation, Zoom has taken a huge growth as many companies have gone to working at home or having hybrid, right? X amount of time in the office and X amount of time at work. So I believe this has helped Zoom fuel its growth. And to be honest, after the whole COVID situation is done, I do believe Zoom will still be strong, but But I don't know why. I feel like Teladoc has a little stronger market growth in the upcoming years compared to Zoom. Even though Zoom historically has been a monster that, as we have seen, for some reason, I just have this gut feeling that Teladoc is going to expect more future growth just because of the overall market compared to Zoom. And again, this is probably the place we're all going to disagree with. And let me know, what are your thoughts if you believe Zoom is actually going to grow faster than Teladoc. The great thing about Zoom is it's still expanding into new countries. It is still hitting new markets, and it's also being kind of innovative with some of the new solutions it's coming out with, so that can continue to fuel this crazy amount of growth for Zoom. But for here, the point I am gonna give to is TELEDOC. This is the one I personally am a little bit more bullish on. Like we can see, TELEDOC comes out with 3 points and Zoom ends up coming out with 4 points. And these 4 points gives Zoom the overall win. Again, this doesn't mean TELEDOC is a bad investment. I think I personally would enjoy TELEDOC a bit more. But if we were just taking a look at some metrics to see which one had better numbers, I do believe it's always good to take a look at numbers and see how things are moving. We can see, right, Zoom killed it with margins, it killed it with revenue growth, it killed it with cash flow margins, and it also killed it with that super strong balance sheet. Of course, it is expected to be more expensive when we take a look at things like price to sell valuation, because it's giving more to investors in those form of returns. So let me know, are you guys happy with today's episode? Did you expect Zoom to win, or are you still more of a TELEDOC bull yourself? So take care, guys, have a good night, and see you next time.